Okay, in this video, we're going to talk about the pricing mechanism for options. And to go through this process, we're going to go through three categories, if you will, or three theories of how we can determine the value of options. And so as we go through here, let's think, obviously they're theories, they're simplified models, but we want to talk about the process of how we might ultimately determine the investment opportunities that are in options themselves. So if you think about an option, there's two values that we can talk about. And in a previous video, we were talking about the difference between the stock price and the exercise price. And that is what we refer to as the intrinsic value. So every option obviously has an intrinsic value. Now that value cannot be negative. So it's either zero or it has a value. So for a call, if the stock price is greater than the exercise price, if the stock was selling for 110 and the exercise price was 100, that would have a $10 intrinsic value. However, if it was the other way around, then the intrinsic value would be zero. However, that doesn't mean that the option still doesn't have value. And the value comes from the option itself, the right to do something. And the other piece of this is what we refer to as the time value. And this is just the difference between the premium and the actual time value, if you will, or the exercise price and the intrinsic value, and the premium. What is the value that's left over? And that is based on time. It's based on how long the ultimate option may be available for us to purchase. So if you kind of think about an option, right? We have an option that could be in the money or out of the money. We know that there is a value to the option. And in the graphs of other models, we were essentially graphing what we refer to as the intrinsic value. So the difference between that value and the ultimate value of the option is the time value. So what creates this value in options? Well, the stock price. And I think the easiest way to think about these in general, is think about a call option and think about whether the value of the option, whether the opportunity for profit is better or worse depending on what happens to this particular variable. So for a call option, again, remember, we think you want to buy this when you think the stock price goes up. So let's think about stock price. If the stock price goes up, then the value of the call goes up because, again, that's why we're placing this bet. Now, what about the exercise price? If the exercise price gets higher, that means it is more difficult for the option to have value. So as the exercise price goes up, the value of the call declines, moves in the opposite direction. What about volatility? Well, since we're placing strategies and investment strategies on changing prices, we need volatility. So the more volatility there is in a stock or an asset, the greater the value of that call option would be. Time to expiration. Now this says if variable increases, just because we're keeping them all the same. But think about it, the longer the time that you have for your opportunity to bear fruit, to become profitable, the better off the chance is that it will happen. So if time to maturity is longer, that means that option is going to have greater value. Now the last two are a little bit different in thinking about them. But interest rates, if interest rates go up, if the rate of return goes up, then obviously there'll be an increase in value because the return in general will be more. So since there's more return available in the asset, that would have a positive influence on the value of the call. And we haven't talked about dividends at all, but if dividends were available, then what would happen if you had an option? If you bought a call option and a dividend was paid, since you don't have the stock, you wouldn't get the dividend. So if dividend payouts increase, the values of their calls are going to move in the opposite direction. So again, we can figure out how this works with respect to calls. So as we move on, again, we just want to try to envision, if you will, how value is ultimately created. Again, call value cannot be negative, right? It's zero at worst. So the option payout is highly positive at best. So call value can't exceed the stock value, right? So the value of the call is always going to be greater than the value of levered equity. So there is a lower bound, right? That's what we might refer to as our adjusted intrinsic value. So the value of the call is going to be greater than the value of the stock minus the present value of the exercise price minus the present value of any dividends. So what we end up with is we have a range that the call value has to be within a certain range. It can't exceed the stock price and it cannot be below that adjusted intrinsic value. So as we look at this, if you kind of think about a call option as the value changes, we know what? That the value of the call is this. As the stock price goes up, we know that the value of the call goes up. But it has to maintain itself within these boundaries. It can't be higher than one or lower than the other. So where we're kind of moving in this direction is trying to figure out, when you think about the value, what would you be willing to pay for something? It has to be within this range. And I don't think necessarily that that's that difficult or that important, quite frankly, to understand the valuation process. But we do need to understand that with respect to things like arbitrage and other choices, there are boundaries for pricing. So the right to exercise an American call early is valueless if the stock pays no dividends until the option expires. So what does this mean, right? So again, that right to exercise early, right? Remember, American call, you can exercise prior to maturity. If the stock doesn't pay a dividend, then that right is worthless. If it does pay a dividend, then by exercising early and owning that stock, now you would be entitled to the dividend, then it would have value. So the value of an American call equals the value of a European call if there are no dividends. So the call gains value then as the stock price rises. So essentially what we say is the call is worth more alive than it is dead. And for that reason, again, you would never want to exercise options, a call option early. And American puts are worth more than European puts, all else being equal. Why is that true? Well, because the value of the stock cannot fall below zero. Once the firm's bankrupt, it's optimal to exercise the American put immediately because we still have this time value of money issue with respect to cash flows. So again, think about early exercise. Should we or shouldn't we? If there are dividends, we should never exercise a call early because European and American calls are the same. But American puts are always worth more than a European puts. So if it is possible, we might particularly want to exercise an American put early. However, we still have to worry about the time value of our ultimate investment bet, if you will. So let's think about, let's move to something a little bit, maybe a little bit more intuitive, right? So let's think about how we might determine option prices. How do we get them? Now let's think about a few things before we get there. We have a law called the law of one price. Two things that are identical have to have the exact identical price. We also have a concept called arbitrage. And we know that arbitrage in the real world can't exist. So that means that the pricing theories have to hold and they have to be true. So we're going to look at 3 stages of theory, if you will. So the first thing we're going to assume is that investors are risk neutral and there's equal probability of stock values. Now, in the textbook that we're currently using, this isn't in that textbook, but I like this explanation because it gets us to think a little bit about options and what they mean, but it also makes it very easy for us to demonstrate what happens when the variables change. So we'll see that as we work through this example. The next example is we will relax the assumption of risk neutral. We'll add some uncertainty. And then in the end, we're just going to assume that stock values are normally distributed. So let's start with what we refer to as uniform probability distributions. And we have worksheets that can help us work through and calculate all these values that are done in the formulas here. So let's start with valuing a call, right? So we have a stock, it pays no dividend, expires in a year, and there are 2 possible future prices that have equal probability. The future price will either be $50 or $10. And since we're talking about this equal probability, this is what's referred to as a uniform probability distribution. So if we have a risk-free investor, we always know we're going to use the risk-free rate of return. So let's assume we have an exercise price of $30. So what is the present value of this stock? Well, our formula, it's the expected present value today is the future value expected at the end of the year divided by 1 plus the risk-free rate. That's a present value calculation. And we know there's a 50-50 chance of it either being $10 or $50. So if you figure out this calculation, right, the average price is $30. 10 plus 50, $60 divided by 2. So the average price is expected to be $30. 1 plus the risk-free rate of 10% is $27.27. So that's what we estimate the current value to be of the stock. Now, if we then look at the call, right, how do we find the expected value of the call? So the value of the call is the value of the stock minus the exercise price, or 0. We know that formula. So let's look at the formula for calculating the expected value of the call. It's the value of the stock at the high price minus the exercise price divided by 2. Now, why don't we do it with the low price? Because the low price, we know that that's 0. That expected value is 0 for any price of stock less than $30. So there's a 50% chance that the stock will have a value between against the average here. That's $40, right? So it's $20. Now we need to multiply that by the probability of occurrence. So here's the high stock price minus the exercise divided by the high minus the low stock price. So in the end, we have that the expected value in the future, 1 year from now, of the call is $5. Of course, we have to find the present value of that. The present value of this call is $4.55. That's what it should sell for. What about the put? Again, we go through the exact same calculations, except now the put's only going to have value less than $30. And again, the value of this put is still $4.55, going through the same mathematical process. So if we look at some relationships then, what happens if we shift the stock price to the right? That is, what if the stock price goes up? Now we're utilizing the uniform distribution option pricing worksheet. So now we just change the exercise price is 30. The expected price is 60-20, where before it was 50-10. And what we'll find out is the stock price went up, obviously, because we moved it to the right in our distribution, but that also caused increases in an increase in the call value and a decrease in the put. And that makes sense. If the stock price is rising, the value of the call will go up because it's more likely your bet will come true. And the value of the put will go down because now it's less likely that your bet will come true or that you'll have profit. What happens if we expand the variance? That is, what if we widen the possibilities? So we're going to use the same basis, the same kinds of information, except instead now of going from 10 to 50, we'll go from 10 to 70. Everything else stays the same. What happens then to the values of our opportunities? The expected stock price is 36.34. We've got that. So that went up. The expected call, that increased. And actually the put also increased. So when you increase the variance, the range of opportunities for the price to move in, that will have influence on increasing both the call values and the put values. So what are the conclusions we can come to from this example about the prices of options? As stock prices increase, the values of calls go up and the puts decrease. As volatility goes up, increases in both values of puts and calls. So for a given change in variance, though, the price change of out of the money options is greater than in the money options. So if you have two options, one's out of the money, one's in the money, if variance changes, the price change will be greater for out of the money than in the money. Options are more volatile in percentage terms than stocks. That's because of the leverage influence. And out of the money are more volatile than in the money. So we understand that there's so many variables at play here, right? 4, 5, 6 variables that can ultimately have an influence just on the formulas. Let's not even think about what affects those variables themselves. So the next thing we can do is we can revise our discussion and let's add some uncertainty. So we have a stock at $100 and the stock is either going to be 120 or 90, right? Let's assume that this call option has an exercise price of 110. So the call in the future will either be $10 or $0. So how can we utilize this to help us with understanding values? Well, let's talk about this is what's referred to as a two-state call option pricing model. We talked about the variables. The rates of return are either going to be minus 10 or plus 20. And the price can either be, again, 90 or 120. Risk-free rates, 10%. How we want to view this is we want to think about a hedge investment. We're going to buy one asset and we're going to sell the other. So let's say we're going to buy stocks and sell options. So how many options do we need to sell? Well, what we need is what's referred to as a hedge ratio. The calls that we sell per share, the formula is it's the high-low spread for stock, 120 minus 90, divided by the high-low spread of the options, which is 10 minus 0. So what this tells us is we need to sell 3 options for every 1 share that we buy. So if we buy 100 shares, we're going to have to sell 300 options. So let's see how this helps us with pricing now. So we now own 1 share and we sold 3 calls. What happens if the stock price goes to $90? You own 1 share worth $90, but the owners of the options are not going to exercise it, so they have no value. So the total value of your portfolio, if the stock goes to 90, the value is $90, the value of the stock. But what if it goes to 120? You have a share that's worth $120, but the owners of the calls are going to want to exercise. So they're going to give you $110 each. That's $330. But you have to go out and buy the stock. Well, the stock's currently selling at 120. So you're ultimately going to spend $360 and an extra $30, right? So the net value of this portfolio is you have the value of the stock minus the $30 you had to spend, which now tells you still have $90 in value. So what this portfolio of 1 share, 3 calls created is essentially a risk-free investment. No matter what happens, your portfolio is going to be worth $90. So how does that fit into our formula? The only thing we haven't incorporated here is what do you need to pay for the call premiums? So the portfolio is the year-end portfolio value, which we know has got to be $90. You divide that by the stock price minus how many calls there were. Well, in our formula, there's 3 calls, times the premium. And this portfolio, since no matter what happens, it's going to be worth $90, it has to be worth the risk-free rate of return. So now we need to solve this formula for the call option premiums. And again, if you do that math, again, there's a worksheet called the Binomial Option Model. Go through this. Here's our values: 110, the stock price is 100, increases and decreases in the values of the options that are possible based on pricing, right? 10% is the risk-free rate. We know that the stock price is either going to be 120 or 90. The future value of the options either 10 or 20. We need to buy 3 calls, which means the portfolio value, again, is going to be solved. It's going to be worth $90. So this call premium is going to be worth $6.61. It has to be worth $6.61 because this formula is a risk-free portfolio and it has to equal this 10%. Now, what can we do with puts? The exact same process goes with puts, except now We're going to talk about how many puts are we going to buy per share. Again, it's just the spreads of the stock divided by the spreads of the option. In this case, it's 3 halves. So for this exact same worksheet, again, this is just the bottom of that, we put in the price of the put, or the exercise price. It's 110. So now we know the future put's either going to be 0 or 20. Puts to buy, we're going to buy 1.5 puts. The portfolio value in this instance is going to be $120. So the put premium, again, is $6.61. Again, it has to be $6.61 because we're solving the portfolio return formula, and that's a risk-free formula. Now we can expand this into more than 3 periods, and certainly the mathematics gets dramatically more difficult once we move into 3 intervals rather than just 2 intervals. But we can say the stock can go up, it can go up 3 times, stock can go up and then down and then up, so it went up twice and down once. Again, the mathematics for this types of option pricing models is much more complicated. But the same process, the more we do this, the closer we'll get to the correct price of those option premiums in the end. So I know that's a little bit detailed, it's a little bit complex, but we've accomplished some things. One of the most important things I think we've accomplished is understanding how the variables within the formulas affect ultimately the value of the options. So we'll move to the next video.